participants. A good morning to all of you participants in this program. And let me again thank CAFRAL for having given this opportunity to interact with the participants of the virtual conference on green and sustainable finance. The theme of today's conference, Green and Sustainable Finance, is highly contextual. While the pandemic brought in myriad set of challenges for the authorities around the world in framing and implementing policies for supporting lives and livelihoods, it has also given us time to pause, reset, and reflect on several things, including the issue of providing a sustainable, greener, and better future for our succeeding generations. The impact of climate change is increasingly seen and felt as it plays across the globe in different forms, be it floods in the United Kingdom, heat waves and wildfires in Canada and Australia, or natural calamities in various parts of India. This conference, organized by CAFRAL, gives us an occasion to gather our thoughts and brainstorm on the road ahead on this critical issue. Climate change is possibly the biggest threat staring at the face of humanity. How we tackle this challenge will be a defining moment of our times. The latest report from the Intergovernmental Panel on Climate Change, released last month, which Indrani had just alluded to just a while back, has further highlighted the need for urgent action on addressing the climate change. The report is a stark reminder for all nations that unless we start taking remedial action urgently, the world is in for difficult times. Let me try to drive home this point by quoting from the report. We can't undo the mistakes of the past. But this generation of political and business leaders, this generation of conscious citizens can make things right. This generation can make the systemic changes that will stop the planet warming, help everyone adapt to the new conditions, and create a world of peace, prosperity, and equity. Climate change is here now, but we are also here and now. And if we don't act, who will? Now, how is climate change actually affecting us and the financial institutions? One, the environmental degradation and climatic change is impacting everything around us. The Global Risks Report 2021 of the World Economic Forum has identified extreme weather, climate action failure, and human environmental damage as the top risks by the likelihood, and climate action failure as the second most impactful risk, only after infectious diseases. The IPCC report highlighted that climate crisis is affecting every region in the world in multiple ways. It provides new estimates of the chances of crossing the global warming level of 1.5 degrees centigrade in the coming decades, and warns that unless there is immediate, rapid, sustained, and large-scale reduction in the greenhouse gas emissions, limiting planet warming to close to 1.5 degrees centigrade or even 2 degrees centigrade will be beyond reach. A report of the Ministry of Earth Sciences Government of India released last year concluded that since the middle of the 20th century, India has witnessed a rise in the average temperature, a decrease in monsoon precipitation, a rise in extreme temperature, droughts, and increase in sea levels, as well as increase in intensity and frequency of severe cyclones. There is compelling scientific evidence that human activities have influenced these changes in the regional climate. Given the profile of the event, it would be worthwhile to deliberate a bit further on the interlinkages between the climate-related risks and the financial institutions. These climate trends and events have a direct bearing on the economy and financial system, including the banks. Uncertainty around the severity and timing of climate and environmental-related impacts are a source of financial risk and may threaten the safety and soundness of individual financial institutions and entities, and in turn, the stability of the overall financial system. It therefore becomes incumbent on financial institutions to manage the risks and opportunities that may arise from environmental degradation and a changing climate. Climate-related financial risk refers to the risk assessment based on analysis of the likelihood, consequences, and responses to the impact of climate change. Thus, climate-related financial risk may arise not just from climate change, but also from the efforts to mitigate these changes. One such example is investment behavior. Globally, many investors have already started to move away from firms which generate greater environmental costs or engage in activities which are likely to cause environmental harm, sometimes collectively referred to as high emitter sector. Excuse me. Such a trend may result in loss of funding or increase in finance costs for the high emitter entities, which ultimately generates viability concerns around such entities. Another important dimension for financial entities is the reputational impact. Reputational concerns arise when customers financed by the financial institutions carry on business activities which have adverse environmental impact. These risks have already started manifesting and are impacting the economy and the financial system. The good news is that the financial institutions have started recognizing this threat. In a recent survey, climate change, I think the survey has been given by the ENY Global, just to cite that. The climate change topped the list of long-term risks for banks for the first time since inception over a decade back. More than 9 in 10 of the surveyed bank chief risk officers viewed climate change as a top emerging risk over the next 5 years. The Financial Stability Report of July 21 highlights the fact that climate change risks are ascending in the hierarchy of threats to the financial stability across advanced and emerging economies alike. Consequently, the need for an appropriate framework to identify, assess, and manage climate-related risks becomes an imperative. Climate risk is thus not just a financial risk, it is also starting to worry financial firms and regulators. Climate change and its impact is increasingly being acknowledged as a key risk driver for the financial system by governments, regulators, and financial firms. Climate risks can impact the financial sector through two broad channels. First, the physical risks, which means the economic costs and financial losses resulting from increasing severity and frequency of extreme weather events and long-term climate change. And second, transition risks, which arise as we try to adjust towards a low-carbon economy. It is therefore important to understand these risk drivers which are likely to affect the financial firms. Let me elaborate a bit on both these aspects. One, coming to the physical risk drivers, these are directly observable, excuse me, and often refer to the frequent extreme weather events which inflict direct economic costs and financial losses on the financial firms due to increase in severity and frequency of extreme weather events, as well as longer term but gradual shift of climate. Such acute physical risks arise from extreme climate-related events such as heat waves, landslides, floods, wildfires, and storms. On the other hand, chronic physical risks are longer-term events as they arise from gradual shift in the weather patterns such as changes in the precipitation, extreme weather variability, ocean acidification, and rising sea levels and average temperatures. Importantly, physical risks impact depends largely on the geographical location as different regions display different climate patterns. Transition risks essentially reflect the compliance cost when we draw up an action plan and embark upon the process of adjustment to a low-carbon economy. This would include changes in the government policies, market and customer sentiments, and necessity for technological upgradation. Mandated climate-related mitigation plans could cause decrease in the financial valuations or downgrade of credit ratings for businesses which are violating the climate norms. Such plans can also cause a shift in the market power from one firm to another through introduction of subsidies to compliant firms. Climate risk poses a challenge in as much as it is difficult to measure and quantify. The broader issue which we need to be aware of and respond to is that climate change is affecting financial firms through both direct and indirect channels and has a number of elements which present unique challenges and may, in fact, require a de novo approach to financial risk management. The key elements of the climate change outcomes are: one, the impact is far-reaching in its breadth and magnitude, relevant to multiple lines of businesses, sectors, and geographies. Given the unprecedented nature of the change outcomes, historical data and traditional backward-looking assessments methods are likely to adequately capture future impact. Climate risks materialize over uncertain and extended time horizons, which generally extend beyond financial and business cycles. We also have to be prepared for uncertainty of outcomes, even when we are unable to foresee the nature of the events. It is therefore important to develop a better understanding of the interaction between climate risks and business activities of various firms, as well as the compounding effects such risks may have on the various prudential risk categories. For example, one, the rising frequency and the severity of extreme weather events can impair the value of assets held by the bank's customers or impact supply chains affecting customer operations, their profitability and business viability, which will affect the assessment of credit risk. Shifts in investor preferences could lead to decline in valuation and increased volatility in the bank's investment books, requiring change in the provision for market risk capital. Increased demand for precautionary liquidity to respond to market volatility arising from extreme weather events may induce need for higher liquidity buffers. Disruption in business continuity, given the impact on the financial firm's infrastructure systems and processes and staff, is also a factor to be considered. The financial firms and banks are thus exposed to climate risk through its derivative impact on all in-model risk categories which a bank or a financial firm face, which includes underwriting risk, reputational risk, and strategic risk. Therefore, it is important to recognize the impact of climate risk on the financial firms and plan for it. Although the physical and transition risk drivers and transmission channels through which the climate risks affect financial institutions are increasingly apparent, quantification of these risk elements remains a challenge for financial firms and their supervisors. Measurement efforts have been hampered by data gaps and methodological hurdles, many of which are unique to climate change and contribute to elevated uncertainty in estimates of climate-related risks. For instance, assessment of the potential impact of climate change may require precise data on the location of a borrower's assets and business operations, as well as information on the local weather patterns for these locations. It may also require knowledge of the counterparty's carbon emission and policies and the policies of different industries and jurisdictions. Data at this level of granularity is often unavailable or difficult to acquire, presenting challenges in calculating the magnitude of climate-related financial risks. There is a case to act early and ensure orderly transition. Both climate change and transition to a carbon-neutral economy have the potential to affect economy and, by extension, the general welfare of the people. Hence, there is a clear benefit to acting early and ensuring orderly transition. While transition costs may be higher in the short term, they are likely to be much lower in the long run when compared to the cost of unrestrained climate deterioration. It is thus vital to make the financial system more resilient in the face of increasingly ominous potential cost of accidents caused by catastrophic weather events. The central bank community is aware of this and is engaged in working on this area, much like the consolidated work undertaken after the global financial crisis, which incidentally had added resilience to the financial sector, which came in handy during the pandemic. But more than that, supporting innovation in new technologies, that is clean energy and climate-related research and development, is paramount, as is acting and investing in green infrastructure that uses better standards and lower carbon production processes. The financial industry has a role and responsibility to develop new financial instruments to channelize savings towards green initiatives to make them more sustainable, rewarding, and impactful. Green and sustainable finance is, in general, the route the financial sector is taking for this transition. One such aspect is the green bonds, which are gaining momentum. On a conceptual level, green finance can be defined as financing of investments that deliver environmental benefits in the broader context of environmentally sustainable development. These environmental benefits include, for example, reduction in air, water, and land pollution, reduction in greenhouse gas emissions, improved energy efficiency while utilizing natural resources, as well as mitigation and adaptation of climate changes and their co-benefits. Such a definition is directionally clear, while allowing for different technical interpretation by the countries. In particular, interest in green bonds and green finance is progressively gaining momentum as it becomes a priority for many issuers, asset managers, and governments alike. Global issuance of green bonds surpassed $250 billion in 2019, about 3.5% of the total global bond issuance, which was around 7.15 trillion. Projections estimate that the issuance of global green bonds is likely to reach about $450 billion this year, and there is a high possibility of issuance surpassing $1 trillion in 2023. Overall, the developed economies contribute a major part of the green bond issuance globally. Among the emerging economies, India occupies the second spot after China in the cumulative emerging green bond issuances between the period 2012 to 2020. A number of initiatives are underway in the international fora, central banks, academics, and private stakeholders to study climate-related financial risks. Critically, climate-related topics are being given an important place both at the G20 and G7 agendas for 2021, and preparations are underway for the COP26. The G20 for the first time adopted a joint final communique which gives momentum to the common mission of the G20 countries to preserve global climate and ensure a clean and inclusive energy transition. They agreed that the crisis unleashed by the pandemic reinforced the importance of using science as a compass to guide the development of policies aimed at ensuring common good. In this sense, it's important that for the first time, the G20 recognized the fact that impacts of climate change will be much lower. In the context of global temperature rise not exceeding 1.5 degrees centigrade than in the case of a 2 degree centigrade increase, as affirmed in the global warming of 1.5 degrees centigrade IPCC special report. On the basis of this conclusion, the members of the G20 decided to accelerate action to keep this 1.5 degree centigrade limit on the rise of global temperatures within reach during the critical decade of the 2020s. G20 has thus made climate action a key priority and an integral part of the recovery from the pandemic. Tackling climate change and other challenges needed to bring economic development onto a sustainable path requires the involvement of the financial system and its alignment with the objectives of the Agenda 2030 and the goals of the Paris Agreement. In line with its vision articulated around the pillars of planet, people, and prosperity, G20 re-established the Sustainable Finance Study Group. In parallel, the Financial Stability Board is working on ways to promote consistent, high-quality climate-related disclosures in line with the recommendations of the Task Force on Climate-Related Financial Disclosures. It is also continuing to work on data requirements and gaps that are crucial for assessing the financial stability risks resulting from the climate change. Concurrently, the International Financial Reporting Standards Foundation is moving ahead with a proposal to set up an International Sustainability Standards Board to deliver the first consistent single set of global norms for climate-related company disclosures. There is a role in the climate fight for addressing the climate finance risks for the central banks, the BCBS, as well as the Network for Greening of Financial System. The fight against climate change is certainly a task for the global economy, the society, and its institutions, which includes the central banks. Greenhouse gas emissions do not stop at national borders, and international trade accounts for a significant share of global emissions. At the same time, we need to understand the roles played by all relevant actors and how they complement each other. Therefore, coordination at the global level would be essential. Central banks are engaged in many international fora that have made climate change a top priority, which includes the central banks and the supervisors network for greening of financial systems, and the Basel Committee on Banking Supervision's Task Force on Climate-Related Financial Risks. The NGFS is a group of central banks and supervisors willing to share the best practices and contribute to the development of environment and climate risk management in the financial sector. In order to learn from and contribute to the global efforts towards enhancing the role of global financial system to manage risks and to mobilize capital for green and low carbon investments, the Reserve Bank of India joined the Network for greening of financial systems as a member central bank in April 2021. The bank expects to benefit from the membership of NGFS by learning from member central banks and regulators and contributing to the global efforts on green finance and the broader context of environmentally sustainable development. It has accordingly begun participation in the work streams of the NGFS and would be making use of the NGFS platform to equip its officers with the necessary skills and knowledge on climate-related risks. The BCBS, on the other hand, has focused initial efforts on analytical research on the climate topic over the past few years and published two important analytical reports on climate-related risk drivers and measurement methodologies. Taken together, the reports conclude that climate risk drivers can be captured in traditional financial risk categories. But additional work is needed to connect climate risk drivers to banks' exposure and to reliably estimate such risks. While a range of methodologies is currently in use or is being developed, challenges remain in the estimation process, which includes data gaps, regional variations, and uncertainty associated with the long-term nature and the unpredictability of climate change. The ability to estimate and effectively mitigate climate-related financial risks will improve when we are able to iron out these challenges or could find an alternate approach. The Task Force on Climate-Related Risks is working to identify the potential gaps in the Basel framework and develop appropriate measures to address them. Now, coming to the role of RBI on sustainable finance in a dynamic world. The Reserve Bank's mission statement encompasses universal access to financial services and a robust, dynamic, and responsive financial intermediation infrastructure, and recognizes the importance of active and receptive financial intermediation. As the economy and financial system are not static, we need to appropriately respond to the changes around us. We also need to proactively consider new and emerging risks and opportunities while delivering monetary and financial stability in a time-consistent manner. The Reserve Bank has advised the banks to put in place an appropriate action plan towards making a meaningful contribution to sustainable development. Slowly and steadily, the bank has been incentivizing bank lending towards greener industries and projects. For example, renewable energy projects have been included in its priority sector lending guideline, as part of priority sector lending, In 2012, Reserve Bank included loans for setting up off-grid solar and other off-grid renewable energy solutions for households, and 2015, the priority sector lending criteria was expanded to include solar power, biomass generation, and other electrification projects. In 2019, the on-lending rules were changed to increase the financial flows via non-banking institutions to renewable projects. And in 2020, the range of eligible solar projects was expanded. The Reserve Bank has also tried to spread awareness on the issue of green and sustainable finance by discussing the opportunities and challenges of green finance through its publications and other communication. For instance, in its report on the trend and progress of banking in India in 2018-19, the Reserve Bank noted the risks of a climate change on financial assets and the need to accelerate the green finance for environment-friendly, sustainable development. Now, coming to the way forward, I think we need to be conscious that addressing climate financial risk in the financial sector is our joint responsibility. As risks and opportunities and financial impact arising from climate change vary across jurisdictions, this poses unique consideration for emerging economies like India. The challenge before us is to mainstream green finance and incorporate the environmental impact into commercial lending decisions, while simultaneously balancing the needs for credit expansion, economic growth, and social development. Recently, in the Reserve Bank Department of Regulation, we had set up a sustainable finance group, which will be spearheading the Reserve Bank's efforts on sustainable and green finance. Some of the initiatives which we are contemplating and discussing within the Reserve Bank are: 1, integrating the climate-related risks into financial stability monitoring. 2nd, building in-house capacity for assessment and monitoring of climate risk and generate awareness of climate-related risks among regulated entities. coordinating with other financial regulators to better understand the climate-related risks to the financial system and those related to transition to a low-carbon economy. Advising regulated entities to have a strategy to address climate change and ESG risks and appropriate governance structures to effectively manage them from a microprudential and a financial stability perspective. Then finally, exploring forward-looking tools like climate scenario analysis and stress testing for assessing climate-related risks. In conclusion, just let me add that the global understanding of the systemic impact of climate change on the economy and the financial system, as also its resultant impact on financial stability, is evolving. And accordingly, the response of central banks and supervisors around the world have also been developing. Dealing with the climate crisis is an unprecedented challenge. The private and the public sector needs to build on our early progress, both by recognizing what we do know and urgently filling gaps around what we do not. I would also like to emphasize that this is not about a particular industry, a central bank, or even a country. The impact of climate risk transcends across national borders and continents. Let us remember that even the countries which are not major contributors will also be equally impacted by these risks. We are all in it together. All of us should recognize that the fight against the climate change is at this juncture cannot be categorized as a marathon, nor is it a short sprint. It has to be a well-judged middle distance runner. Every step counts along the way. In closing, ladies and gentlemen, I wish you a full day full of good discussions and insightful deliberations. Thank you for your attention. Thank you. Stay safe.